Okay, greetings, students. So today we'll do a little recap of our Chapter 9 on bonds and leasing. And we'll start off by reminding you of the basic concept of discounts and premiums, that discounts will cause a bond to have more interest expense over its life, more effective interest expense. A premium will cause a bond to have less interest expense. This is from the issuer. Just to take a bird's eye view, if the bond is issued for a discount, it means the company gets less dollars and has to pay out more dollars at the end of the life of the bond. Take a look at how that works, because the more dollars is the face value of the bond, but they didn't get the face value when they borrowed because it was sold at a discount. That means effectively it's a higher interest expense to the issuer of the bond. Interest is higher, and the opposite with premium. So just wanted to make sure you got that basic concept. All right, moving right along, I want to talk about the fact that you should have a pretty good idea of maybe not memorized, but how to recognize the 4 criteria for whether it's a capitalized lease. We didn't go over each one of them in fine detail, but you should look those over for criteria for capitalized lease. Make sure you thoroughly understand that. All right. Now, when it comes to a capitalized lease, often what happens is that we have a liability on a capitalized lease, which is equal to the present value of the future payments. Present value of future payments. And that can be calculated using an annuity table. However, if a problem were to give you the present value of the future payments and say, okay, what happens next year? What is the future payments next year? There's a simple way to calculate that. Let me give you an illustration. If they tell you that the future payments of the annuities for the lease, the capitalized lease, is X, and let's say there's a minimum payment each year of 100 on this so-called lease. So they'll also probably tell you, they will tell you the percentage that's inside of the deal, how much is the percent interest used. So what you would simply do is you would take from the last present value they gave you, you would take 10% of that number to figure out what the next effective interest portion of X is for a year, and subtract it from the 100,000 to understand the amount that's going towards principal, and then you would reduce the X going forward. It's nothing less or more than a simple amortization schedule. So if X is the present value of the future payments, it's just like any other liability. That's the point of why they want you to understand this, is the point of any other long-term loan. So you have fixed payments every month, 100,000, every year. The fixed payments are the annuity over time, and they want you to just know what is X minus 1 year, X the next year. So X would be the principal remaining after the interest expense in the next year. So this calculation isn't any different than that. You simply apply the 10% interest rate to X to figure out what the interest is in the next year, which would be Y, and then you're going to figure out what the principal payment would be, which would simply be the 100,000 minus Y would give you Z, the principal amount. The principal amount reduces X to really become the X minus 1. So Z in this equation is X minus 1. Looks like a lot of physics, calculus, and highfalutin mathematics here. We're almost rocket scientists doing this kind of work. If you have any questions on what I just showed you, let me know. But it's no different than any other amortization schedule. So that would be a simple way of answering the question of what's the new present value. All right, moving along. When we did the calculations of the carrying value of bonds, you will remember whether it was discount or premium, we were concerned with calculating the actual interest expense, the actual effective interest expense each year to take in order to know what the next year's carrying value was. If you take a look at the agenda and the problems that we did and how those answers worked, you will see what I mean. And the point of this whole mentioning of this now is to just let you know that the same process that helped us calculate the new carrying value based on the effective interest rate method also gave us the interest expense under the effective interest rate method. So you answer both questions using the same kinds of calculation. So again, I guess the point is to know that the effective interest rate method, which shows the carrying value on the balance sheet of the company with the bond, is also a method for figuring out what the effective interest rate or interest expense is that they're going to use on their financial statements. They're going to actually record the effective interest interest expense based on the effective rate. All right, I did confirm that the bond price or bond calculating app that I sent to you does work with any problems that you would encounter for both the pre-quiz or quiz, so that you can make use of that if you don't have any other method of calculating bond price. Also recall that the actual payment made on the bond is the coupon amount. The effective interest rate, or the effective interest expense based on the effective interest rate that we just mentioned, is what gets recorded in the books, is not what's paid. The payment is the coupon per the contract. Finally, there is on the quiz, the actual quiz, there's a problem that is asking you to compare the relative fair prices or market value prices of bonds when they are selling at either a premium or a discount, and to understand how bond prices will work in the real world based on the initial contract of those bonds. Can't give the problem away, obviously, but I want to let you know that it uses the word both in the multiple choice answers, and that word really means bond. So when you see the word both in one question on there, it really means the word bond. Hopefully that'll reduce the confusion when you're trying to read through the question and get the answer. Okay, that's about it for now. Good luck. Talk to you later. Let me know if you have any questions.